Thursday was a bloodbath in financial markets, and no asset was safe. Even the traditional safe haven appeal of gold wasn't all that appealing, with the yellow metal sinking, presumably as portfolio managers were forced to book profit on their long exposure to offset intense setbacks on the equity side. The S&P 500 has now fallen about 30% from its record high just weeks back in February, and the fear and panic from coronavirus fallout has been driving the move. But it's not just coronavirus. It's the fact that we've also reached a point post-2008 financial markets crisis where central banks and government stimulus efforts just aren't as effective as they once were. Over the past week, we've seen a lot of this, with central banks slashing interest rates and introducing new measures to help prop up the economy while governments commit to additional stimulus. And yet still, investors aren't as enthusiastic. The fact that the catalyst for the downturn has come in the form of a downside risk where monetary stimulus is less reassuring isn't helping matters either. People are worried about their physical well-being and are looking for answers that will set their minds at ease. What good is liquidity if no one is willing or able to step out of their own homes? On Thursday, the Fed announced another massive liquidity injection, hoping that it will do something to stabilize global markets, and other central banks and governments are trying to do their best as well. On Thursday, we also saw the ECB defy expectation for additional rate cuts, instead looking like it wanted to put pressure on government to step up to the plate. Overall, we've transitioned into rougher waters, all of this overdue, and all of this anticipated given how much has already been extended to the global economy over the past decade plus. There are likely to be additional negative shocks, and the global economy will need to fight through, knowing that it won't be getting the same boost as it once had. Central banks and governments will do what they can, but it's likely to be a tough go for a while. As far as currencies go, we expect the current environment will lead to major currency outperformance against the commodity block and emerging market currencies, and we expect this outperformance will be shared amongst the major currencies, with the dollar less inclined these days to be carrying the entire load. That's all for now.